Benjamin Franklin famously said there are only two things guaranteed in life: death and taxes. He didn't specifically say property taxes, but if you've ever owned real estate or looked at buying a home, you know they're just as inevitable. And yet, property taxes are one of the least understood parts of home ownership. Now, people know they exist, they know they show up somewhere on the mortgage statement, but most buyers don't actually understand what they are, how they're calculated, or why two nearly identical homes can have wildly different tax bills. So in this video, I'm going to break down what property taxes really are, why they exist, and how they directly affect you when you're buying a home. Like most people, the only time you really think about property taxes is when you see the number attached to the house listing or a mortgage estimate. But to understand why that number exists, we need to zoom out for a moment. At its most basic level, property tax is a tax assessed on real estate owned by an individual or a legal entity, like an LLC or corporation. But that definition doesn't tell you much. The real question is, where does that money go? Property taxes are one of the primary ways local governments fund themselves. And unlike income taxes or sales taxes, which often go to the state or federal budgets, property taxes mostly stay local. That money pays for things like public schools, police departments, fire departments, EMTs, road maintenance, snow removal, sanitation services, libraries, parks, and other local infrastructure that people rely on every single day. And by far, the largest portion usually goes to public schools. In many areas, property taxes make up the majority of school funding. So whether or not you have kids, if you own a property, you're contributing to the education system in your community. Now, this is important to understand because property taxes aren't random. They're tied directly to how local governments function. So let's get into the mechanics because this is where things start to matter financially. One of the biggest sources of confusion around property taxes is the difference between market value and assessed value. Market value is what a property would realistically sell for in an open market, meaning a willing buyer and a willing seller, neither under pressure. This is the number you see when homes are listed for sale, and it's influenced by comparable sales, demand, location, condition, and market trends. Assessed value, on the other hand, is the value assigned by the local tax authority for tax purposes. And here's the key point. Those two numbers are not often the same. That's because property taxes aren't usually calculated using full market value. Instead, they rely on something called an assessment ratio. The assessment ratio is the percentage of the market value that's actually used to calculate your property taxes. And this percentage varies dramatically depending on where you live. Some states or counties assess property at 100% of the market value, while others might use 50%, 40%, or even lower. This doesn't automatically mean taxes are lower in places with smaller assessment ratios. It just means the math is structured differently. Let's walk through a clear example. Say a home has a market value of $500,000. If the assessment ratio is 50% in that area, the assessed value becomes $250,000. Now let's say the tax rate is 10%. You'd calculate your annual property tax by taking 10% of the assessed value, which results in a $25,000 tax bill. Same house, same market value, but depending on the assessment ratio and the tax rate, the final bill can look very different. This is why comparing property taxes across states or even counties isn't as simple as looking at just one number. And this is actually one of the biggest mistakes first-time investors make. They'll analyze the purchase price, the mortgage rate, maybe even the rent, but they completely overlook how property taxes affect the cash flow and affordability. Now, this is something we spend a lot of time on inside our real estate course. We help first-time buyers understand how property taxes are calculated, how to estimate them correctly before buying, and how they impact whether a deal actually makes sense on paper, not just whether it looks good online. Another important concept is tax increase caps, and in many areas, there are legal limits on how much your taxable value can increase each year, even if your home's market value skyrockets. And this is designed to protect homeowners from being priced out of their own homes, just because their home's value is rising quickly. So let's say your home jumps in value by 20% in 1 year. Even if the assessed value reflects that increase, the taxable value may only be allowed to increase by a much smaller percentage. Over time, this causes the taxable value to lag behind market value, which can be a major benefit if you stay in a home for many years. However, when a property changes ownership, those caps are often reset. That's why property taxes can jump significantly right after a sale. On top of that, many homeowners qualify for exemptions that further reduce their property taxes. And the most common is the homestead exemption, which usually applies to primary residences. Homestead exemptions can work in different ways depending on the state. Some reduce the taxable value of the home, others reduce the tax rate itself. Either way, they exist to provide tax relief for owner-occupied homes. This is one reason rental properties often have higher property taxes than primary residences. They typically don't qualify for those exemptions. If you're buying a primary residence, understanding whether and how a homestead exemption applies can make a meaningful difference in your tax bill. Always consult with your real estate agent to understand if these exemptions apply to you. You may also see property taxes expressed using something called a millage rate. And instead of showing a tax rate as a percentage, some jurisdictions use mills. 1 mill equals $1 of tax for every $1,000 of assessed value. So if a property has an assessed value of 100 grand and the millage rate is 20 mills, that translates to $2,000 per year in property taxes. Team, you don't need to memorize the math. You just need to recognize the terminology so you can understand what you're looking at when researching the tax rates. Now let's bring this back to how property taxes actually affect you as the buyer. When you take out a mortgage, property taxes are often collected monthly and held in an escrow account. Instead of paying 1 or 2 large tax bills per year, your lender divides your estimated annual property taxes into monthly payments and adds that to your mortgage payment. So if your annual property taxes are $3,600, that's an extra $300 per month added to your mortgage payment. And here's where this really matters. 2 similar homes with the same price, same size, and same neighborhood can have very different monthly payments simply because of property taxes. Different school districts, exemptions, assessment histories, or local tax rates can create huge differences in affordability. This is why property taxes should always be evaluated before you fall in love with a house. In some cases, usually with conventional loans and larger down payments, you may have the option to pay property taxes separately instead of through escrow. But for most people, escrow is simpler. It spreads the cost out evenly and avoids large surprise bills. Either way, the cost is real and it should be part of your decision-making process. The bottom line is this, you guys. Property taxes aren't just a line item. They're a long-term financial commitment tied to your home. Understanding how they're calculated, how they change over time, and how they affect your monthly payment makes you a far more informed buyer, and informed buyers make better decisions. If you're serious about buying your first investment property and want help understanding things like property taxes, cash flow, and what numbers actually matter, that's exactly what we do inside our real estate course, First Asset Academy. We walk first-time investors step by step through buying their first property, including how to properly analyze taxes before making an offer, so there's no surprises after closing. You can learn more using the link in the description. Guys, if you learned something in this video, make sure to hit the like button. And if you're interested in more real estate content, make sure to hit that subscribe button. Thanks for watching, team. I'll see you in the next one.